Yeah, and look, and that party, it's 10:30 p.m. It was 9 p.m., but that party goes to 4 a.m. But look, Scar, we've talked about it. The DJ is gonna stop playing music sometimes. There could be glass on the dance floor. Maybe cops come to the party, but the party's going to 4 a.m. These are just white knuckle moments. What I view is this tech bull market has 2 more years ahead of it in terms of the AI super cycle of CapEx.
Dan, I know you travel. You spend a lot of your time traveling around the world, visiting your institutional investor clients, meeting with the companies you cover. I'm sure question number 1 or 2, or maybe 1 and 2, is about the AI bubble here. How do you put that into context in terms of some of the spending?
Yeah, Paul, I put in context, as someone like myself who covered tech stocks in the 90s, the average tech company was 30 times revenues. Now the average tech company is 27 times earnings. Big tech, trillion on the balance sheet, 300 to 400 billion a year of free cash flow. CapEx next year is probably going to be 580 to 600 billion. It all comes down to demand and supply that we're seeing. And I mean, just come back from Asia, demand and supply for Nvidia chips is what, 12 to 1, 15 to 1. So I get the concerns, but it's my view investors are underestimating the scale and scope of what this is going to ultimately look like.
Maybe part of it is because investors are focused on earnings 12 months out, revenue 12 months out, and this is a story that needs a longer runway beyond 12 months. How many years are we talking about?
I mean, I think if you're Meta is a good example, right? Like that stock, phenomenal earnings, CapEx ramps up, earnings, free cash flow goes down next year. But when it comes to Meta, right now Zuckerberg's wartime CEO, focused on the future, next 2, 3, 4, 5 years. That's the right move for them to make. And that's why I just view this as you have to have a longer perspective. Just like Palantir, you're never going to ultimately look at Palantir over the next 1, 2 years. I think Palantir is $1 trillion market cap in the next 2 or 3 years.
Some breaking news this hour. Anthropic has announced plans to spend $50 billion on data centers in the U.S. Let's get the details with Bloomberg Tech co-host Ed Ludlow. And just looking at this headline, I'm kind of like, they didn't already promise that. It feels like every tech company has some huge number that they're going to be spending on data centers. What's Anthropic committing to?
Yeah, $50 billion in partnership with a British company called FluidStack, where they are owning and building and operating the data center facilities. But $50 billion is at much smaller scale than, say, compared to OpenAI. OpenAI, Anthropic's nearest rival as a frontier AI lab and commercial entity, has pledged $500 billion for the Stargate project alone. In the United States, which it had plans to also take overseas. Meta is another good example, a different type of company, but within it an AI lab where their own domestic data center spending will be $600 billion. And for all 3 of those, it's stacked over a number of years. Where Anthropic's perhaps different is that this is $50 billion for something it's doing itself. But it has relied much more heavily on the hyperscale partners that it has, Amazon AWS, and as we reported most recently, Google, for use of Google's TPUs.
Do they have the revenue to fund this? I mean, this is a question that Sam Altman was posed recently because he wants to spend $1.4 trillion, but only has $13 billion in revenue. He didn't want to answer that question.
Right.
What about Anthropic?
So what we know from recent reports is that Anthropic is looking at revenues of about 70 billion, 70, by the calendar or fiscal year 2028. Right now, OpenAI, I think you mentioned the $13 billion figure. Its annual revenue run rate figure is about 20 billion for 2025. One point of interesting difference between the 2 of them, in part because Anthropic has not committed as much capital of its own up front, it's relied on this capital-light model with partners, is that there is a growing consensus that Anthropic may reach profitability quicker than OpenAI does, because OpenAI is committed to spending its way to growth in a way that Anthropic isn't, at that scale.
On November 19th, Nvidia releases its fiscal third quarter financial results. Organizations worldwide are interested in using the company's cutting-edge semiconductor chips to power artificial intelligence systems. In 2025, Nvidia completed several agreements, including a multi-billion-dollar collaboration with OpenAI. Nvidia is maybe the industry leader in the rapidly developing field of artificial intelligence, AI. Wall Street has been watching its impressive AI-driven sales growth for a number of years, but its 2025 big transactions are once again redefining its place in the AI ecosystem. Therefore, it should come as no surprise that Nvidia's stock rose 40% this year, through the week ending November 7th. In July, the company became the first to cross $4 trillion in market capitalization, breaking a record. A few months later, it became the first to surpass $5 trillion, marking yet another significant milestone. Given how AI is affecting many industries, Nvidia is a remarkable firm navigating unprecedented times. However, is it wise to purchase stock prior to the company's November 19th announcement of its fiscal third quarter results? The value of Nvidia is a crucial consideration when deciding whether to invest in the company. This can be evaluated by contrasting a number of measures with those of rivals in the semiconductor industry, like AMD and Broadcom. The price-to-earnings, PE ratios of each company, for instance, show how much investors are paying for a dollar's worth of earnings over the last 12 months. Nvidia is the best bargain among its peers based on its PE ratio, which is the lowest of the three. Even while Nvidia has made some revolutionary announcements since then, like its agreement to invest $100 billion in OpenAI, the company that created ChatGPT, its earnings multiple is actually a little lower than it was a year ago. However, a PE ratio greater than 50 is not inexpensive. However, considering the direction of Nvidia's company, that valuation might be justified. Advanced semiconductor chips known as graphics processing units, GPUs, are the foundation of the company's renown. Video game systems were the initial application for them, but when additional applications for their parallel processing power were discovered, the market for them grew. Additionally, the future of GPUs appears to be more promising than ever with the introduction of AI. According to Nvidia CEO Jensen Huang, AI factories, massive data centers designed to manage AI workloads, will help usher in a new industrial revolution. His prophecy is already happening. In only the next 5 years, for instance, the government of the United Kingdom intends to raise the nation's sovereign computing capability by a factor of 20. Up to 120,000 Nvidia GPUs will be bought in order to do this. However, that is nothing compared to OpenAI's pledge to purchase millions of Nvidia AI chips over the next several years. Furthermore, the market for AI accelerators as a whole may dwarf even that. AI requires specialized chips to function, and this decade will see the replacement of trillions of dollars worth of processing processors. In August 2023, Tejas Desai, a research analyst at Global X, released a new research note. That opinion has been confirmed by subsequent events. The future expansion of Nvidia. The shift to specialized AI processors implies that Nvidia's GPU sales are still in their infancy, and stockholders have already profited from this success. Nvidia's earnings per share, EPS, have skyrocketed in the short period after AI took off with the release of ChatGPT at the end of 2022. Furthermore, the excessive demand for Nvidia's GPUs is only a portion of the total. The startup started out making better visuals for video games and now powers cloud AI. It will now provide mobile networks with AI. Nvidia and Nokia announced in October that Nvidia would invest $1 billion in Nokia as part of their partnership to introduce 6G, the next generation of mobile telecommunications that will support AI-native wireless systems. In September, Nvidia also revealed a new agreement that included a $5 billion investment in Intel. Nvidia will utilize Intel's chip manufacturing capabilities as part of the partnership. As a completely fabless chipmaker, Nvidia has always outsourced the manufacturing of its products. The agreement also expands Nvidia's product line to include Intel's advantages in the PC processor market. Recent acquisitions by Nvidia demonstrate the company's expansion throughout the computing industry. Although its present PE ratio may appear excessive, Nvidia's stockholders may continue to benefit in the years to come due to the company's expanding influence across the tech spectrum and its rising earnings per share. Nvidia is still a good stock to buy because of this. Additionally, it would be wise to purchase its shares before the business releases its fiscal Q3 results on November 19th, as they are now down about 7% from the 52-week high of $212.19 they set on October 29th. According to a note from Bank of America, in October, The majority of active fund managers in the United States still owned Nvidia, with roughly 76% of the company and quarterly gains in breadth. Even while ownership increased 219 basis points from the previous quarter and 539 basis points year over year, Nvidia's relative portfolio weight was only slightly higher than rivals, according to BofA Analysts lead by Vivek Arya at around 1.11x. Despite recent acquisitions, Advanced Micro Devices is still underowned. Its relative weighting is close to 0.19x, and while active ownership increased to about 24% in October from 20% in July, it is still much below the 38% recorded a year earlier. Prior to its Analyst Day, BofA maintained a $300 price target and a buy rating on AMD. The largest quarterly increases in ownership were noted by the bank in Synopsys and AMD, while the largest decreases were observed in Qualcomm, on semiconductor, and microchip. Additionally, depth shifts were observed, with AMD, Teradyne, and Intel showing the largest increases in overweighting. Analysts provided one-year price goals for Nvidia, with an average of $230.21, a high estimate of $389.73, and a low estimate of $100. From the current price of $193.16, the average goal suggests an upside of plus 19.19%. According to projections, Nvidia's value in a year is $336.28, which is a plus 74.09% increase from the current price of $193.16. The fair value at which the stock ought to be traded is estimated by the GF value. It is determined by taking into account past business growth, the stock's historical multiples, and projections of the company's performance going forward. See the forecast page for more in-depth information. Jim Cramer talked about it recently. Cramer began by talking about Nvidia, a major player in AI chips. He talked about a note from Ben Ratizas of Milius Research, which restated a $300 price target and a buy rating. Cramer also cited Citi's report that large tech companies' cloud businesses were growing as a result of the rising demand for AI workloads. Indeed, Milius, I am aware that Ben Reitzes has written a post explaining why you ought to remain inside. Citi has a great article, so it's clear that we're moving forward and aiming for the profits. I'm referring to David. Is it this market's main stock? I would suggest that OpenAI is the key to AI, which doesn't exist. And Sam Altman ends up being this market's main villain, in my opinion. As you can see, just one individual is the reason for a bear market or significant downturn, because they no longer say anything that is useful. TD based of the anticipated strength of the Blackwell Ultra Boost, Cowen reaffirmed its buy recommendation for the tech giant. Additionally, Citi maintained its buy recommendation for the company, aiming for a price objective of $220 from $210. In contrast to analyst projections of $54.6 billion, the company anticipates Nvidia to report sales of $56.8 billion. Bank of America analysts recently reaffirmed their buy recommendation on Nvidia. According to the company, Nvidia has a strong position in artificial intelligence and healthcare. As reported by CNBC, they stated, Nvidia, a leader in accelerated computing, has expanded its reach into high-compute healthcare workloads and continues to engage in partnerships on the application side. Furthermore, UBS analysts predict that Nvidia will guide fourth quarter revenue to between $63 billion and $64 billion. The company currently has a $230 price target and a buy rating. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Tony, thank you very much for joining us. So give me your overall thesis around the idea of AI debt. It sounds like, yes, it's growing. The numbers are impossible to ignore, but not a worry point for you. Why not?
Yeah, I think it definitely is something to watch. But to me, what's most important is that the kind of outcomes they can get with generative AI are still there. I think that we're looking towards agentic AI to push the productivity potential of the technology. And I think all the companies that we talked to over the last few months, no one's taking their foot off the gas pedal. I mean, it's an absolute imperative investment. And I think you've got new companies that are doing new ways of building companies. And then you've got the existing companies that need to adapt to the environment in order to stay competitive. So to me, I think that I'm looking for all these use cases that weren't around over the last few years and that are going to be driving spend going forward.
There are so many ways, I think, to play the AI trade. How are you looking at the different pieces of it? And can you sort of segment for us? Are there areas of more opportunity at this point in where we are and what AI can actually give us?
Yeah, so I think that one is that the compute platforms are going to continue to be the building blocks of the technology. And so I think Nvidia is the platform. I think you also have parts of memory like NAND and DRAM. So NAND, there's going to be a lot more storage of the data, both real world data and synthetic data. So you're seeing bottlenecks appear there, and I think that the industry has consolidated in NAND specifically, and so there's areas to play there. So I think that it's going to be a multi-year investment, and I think we are still early in the S curve of adoption. And if you think about usage of ChatGPT, large language models, I think people are getting a tremendous amount of value. And when you're looking at the engagement and the potential of this technology, I still think it's there to drive a lot of potential disruption too.
Seema was on just before, and hopefully you're able to hear some of her report, but she discussed, Oracle's 5-year default credit swap volume rising exponentially in the last week, potentially some worries about its aggressive debt financing. What do you make of that one in particular?
Yeah, so I think that, it is up, but off of a pretty low base. And so I think it's definitely something to watch. I think at the same time, Oracle, the leverage is manageable. And I think that if you think about this new type of financing, it probably is novel, but over the long term, I do think that people are going to recognize that these GPUs, the useful lives are not really probably 3 years. It's probably more 5 to 6 years. And when they're running, they're generating a lot of profit. And I think we're going to go from this idea of we're just building and ordering GPUs to how much profit can you get from each GPU? Are the tokens profitable? And when we cross that threshold, they become more self-sustaining. So what I'm looking for is the unit economics actually improving. And it's not going to be a straight line, but I think that is important enough that companies are going to figure out a way to drive more usage and drive better productivity for their businesses.
Obviously, your fund has had a nice performance, but when I look at some of the performances individually, Palantir still jumps out at me at up 139% year to date. I know it's pulled back a little bit. AMD up 115% year to date, which then brings up that whole conversation about valuation. If you're not currently in those names, is it too rich to get in now?
Yeah, well, look, I think that we're still early in this investment cycle. And, with those two names, I think Palantir, for example, they're really at the leading edge of implementing AI for companies. And, you've got companies that are spending $80 billion with them. I mean, $80 million. And so, that's a tremendous amount. I think they're driving a lot of value for their clients because they're able to essentially have an ontology that their clients can plug and play AI a little bit more and connect their data. And so I think that, this kind of paradigm is a new shift. And I think with AMD, the market is really growing at an exponential rate. And I think that with what AMD is building, they're going to have a segment of the market, and their development with OpenAI kind of strengthens that. So, I think there's a lot of exciting things that these companies can do. And if they can deliver, I think there's a place for them.